My name is Max Lopez, and this is my presentation of Peachtree Case A. So question 1 asks, why is the return on a T-bond in Table 1 shown to be independent of the state of the economy? And the second part of the question asks, is the return on a 1-year T-bond risk-free? Now to answer the question, T-bonds are fixed-rate government-issued debt securities, which explains why they act independently of the state of the economy. And to answer the second part, in my opinion, T-bonds are risk-free because they are backed fully by the U.S. government. And the U.S. government can always print more money and increase taxes to pay off its obligations. Question 2 asks to calculate the expected rate of return for each of the 4 alternatives listed in Table 1. The second part asks, based solely on expected returns, which of the potential investments appears best? Now, as we take a look at the table, we can see that the T-bond expected rate of return is at 8%, for TECO is at a 13.5%, Gold Hill is at 8.8%, and S&P 500 is at a 15%. Now, to answer the second part of the question, S&P 500 is clearly the best potential investment with a 15% expected rate of return if you base it solely on expected returns. Question 3 asks to calculate the standard deviation and coefficient of variation for each of the 4 alternatives. It also asks, what type of risk do these statistics measure? Is standard deviation or coefficient of variation the better measurement? And how do these alternatives compare when we consider risk? Now we go ahead and take a look at our table. We can see that the standard deviation for T-bond is at a 0%. For TECO, it's at 11.715%. For Gold Hill, it's at a 9.086%. And for S&P 500, it's at a 16.432%. And now we take a look at coefficient of variation. For the T-bond, it's at a 0. For TECO, it's at a 0.868. For Gold Hill, it's at a 1.033. And for S&P 500, it's at a 1.095. Now to answer the other questions, these statistics measure volatility, and when we compare both measurements, we see that coefficient of variation is a better measurement because it's very difficult to compare the standard deviations of 2 separate securities. And when we consider risk, we can see that S&P 500 clearly has the riskiest investment potential, and that's reasonable since the expected rate of return is much higher. Question 4 gives us a hypothetical investor that invests $10,000 in Gold Hill and $10,000 in TECO. Now the question asks us to calculate the portfolio's new expected rate of return, the standard deviation, and the coefficient of variation. It also asks us to compare these values to the individual stock values. Now we take a look at our table, we can see that the new expected rate of return is at 11.15, the standard deviation is at a 2.9, and the coefficient of variation is at a 0.259. Now we can bring down the standard deviation to 2.89 compared to 11.715% and 9.086% from TECO and Gold Hill respectively. Now basically, we still have a large rate of return, but we mitigated the risk very greatly just by diversifying our portfolio. Question 4 continued asks which characteristics of the 2 securities makes risk reduction possible. The second part asks what we would think would happen to the expected rate of return and standard deviation of 2 scenarios, one being a 75% weighted Gold Hill portfolio and the second being a 75% weighted TECO portfolio. Now to answer the first part, to basically get the average percentage of return from 2 different securities enables lower risk. And to answer the second part, we go ahead and take a look at the table. We can see that the expected rate of return of a 75% weighted Gold Hill portfolio would give us an expected rate of return of 9.975 and a standard deviation of 4.48%. Now we go ahead and take a look at the TECO 75% weighted portfolio, and we see that the expected rate of return is 12.325 and the standard deviation is a 6.886%. And this makes sense because taking on more risk gives you more expected return. Question 5 gives us another hypothetical investor that invests $10,000 in TECO and $10,000 in S&P 500 fund. It also asks us, would this new portfolio have the same risk-reducing effects as the original Gold Hill TECO portfolio? And it also asks to construct a portfolio based on S&P 500 and the TECO security. Now, to answer the first question, I didn't expect this to have the same risk-reducing effect as the original portfolio because these securities were performing at very similar rates. Now, to answer the second question, I made this table and it confirms my claims because the expected rate of return is at a 14.25% and the standard deviation is at a 14.0646%. Question 6 asks us a few conceptual questions. It starts off by stating, suppose an investor has a portfolio consisting of one randomly selected stock. Now I ask, what would happen to this portfolio's risk if more and more randomly selected stock were added? The second part asks, now what are the implications for investors? And the third part asks, do effects impact the way investors should think about the riskiness of individual securities? Now, to answer the first part, adding more and more stock to your portfolio increases the diversification. In turn, this will decrease the risk. Now, the implications for investors is to diversify your portfolio to mitigate risk. Now, to answer the third part, I feel that it is up to the individual investor. If the individual investor is more risk-seeking, then he wouldn't mind the effects of individual securities. But if the investor is more risk-averse, then he wouldn't want to take on the risk that comes with individual securities. Question 6 continued. The first part asks, would you expect this to affect the company's cost of capital? The second part asks, explain the differences between total risk, diversifiable risk, and market risk. And the third part asks, assume that you have a one-stock portfolio. Would you expect to be compensated for all the risk you bear? Now, to answer the first part, a company's cost of capital will increase if the perceived investor risk is very high. But it will also decrease if the perceived risk for the investor is very low. Now, to answer the second part, total risk is comprised of systematic and unsystematic risk. And for market risk, also known as systematic risk, this is non-avoidable. You can't eliminate systematic risk. It's just the fluctuations of the markets. And you can only hedge this risk. And to answer the third part, when you're holding a one-stock portfolio, you can't expect to be compensated for all the risk you bear because the markets don't compensate you for the systematic risk that you take on. Question 7 asked me to make a scatter diagram. So I went ahead and put the S&P 500 as the x-axis and the other alternatives on the y-axis. And these lines that you see are called trend lines. And the slope coefficients for each alternative is T-bond 0, TECO 0.7, and Gold Hill at negative 0.38667. And slope coefficients are also called beta. And this is significant because it is used to gauge risk in investments. And the distance between the plot points and regression line are significant because it's the difference between expected return and actual return. Question 8 asks, what is the required rate of return for TECO stock based on value lines estimated beta of 0.6? The second part asks, based on the SML analysis, should investors buy TECO stock? Now, given these numbers and using the Kaplan model, I was able to calculate the required rate of return for TECO stock at 12.2%. And using this graph to visualize the undervaluation of TECO stock, I would advise investors to buy TECO stock. Question 9 gives us different scenarios to play with And to calculate these calculations, I use the Kappa model. So the first scenario is a rise in inflation of 3%. So that would increase the risk-free rate and therefore increase the required rate of return from 12.2 to 13.4%. The second scenario is an increase in market risk premium from 7% to 8%. And then I calculate the required rate of return to rise from 12.2 to 12.8%. And then the third scenario is a rise in the beta from 0.6 to 1. And I calculated the required rate to be 15%. Question 9 continued. It asked us about efficient market hypothesis, and in this hypothesis, it states that you can never beat the market because stocks are always sold at fair value. And question 9 continued gives us a little bit of conceptual questions about it. So what kind of impact does that hypothesis have on decisions concerning investment in securities? Well, you want to invest in really risky securities because that'll be the only way to beat the market based on the hypothesis. The second question asks, is it applicable to real assets such as plant and equipment? Well, I couldn't research anything about it, but in my opinion, I would say it isn't applicable because a lot of assets have a lot of variation, so it would be very hard for it to be applicable in that sense. The third question asks, what impact does EMH have on corporate financing decisions? So someone that's in charge of making those financial decisions has to make really risky bets in order to beat the risk-free rate. And well, even though that isn't very realistic, based on the hypothesis, that's what needs to be done. And then the fourth and last question, should Jake Taylor be concerned about the hypothesis when he's thinking about adding another analyst to his company? Well, based on the hypothesis, it wouldn't matter because an analyst would be useless because stocks always sell at current value. But in real life, there is room to make a profit, and hiring another analyst, would make a lot of sense. Question 10 gives us a scenario where TECO's long-term debt is decreasing and it is looking to decrease further beyond into the future. Now, whenever we think about long-term debt decreasing, that is a good thing, at least for your cost of capital. Now, when you have a really good cost of capital, that means your beta is usually very low. And less volatility also means less required rate of return. And with that, you get a larger room to make profit. And overall, that's a very good thing for TECO's stock and TECO firm. That concludes my case analysis on Peachtree. Thank you for watching.